आइए इस मालूमात का तफसीली जायजा लें। If you're planning to become a tax filer in Pakistan next year, well, you're exactly where you need to be. We've put together this highly detailed explainer to completely demystify those recent, and let's be honest, often confusing announcements from the Federal Board of Revenue or FBR. Our goal today is to help you easily navigate the system and save a whole lot of money in the process.
So tell me honestly, are you planning to become a tax filer in 2026 but feel absolutely terrified of the heavy penalties? Just for trying to get your name on the active taxpayers list, or the ATL? You are definitely not alone. It's a huge source of anxiety right now for ordinary citizens trying to make sense of these complex FBR rules.
Okay, let's dive into this. 25,000 rupees. That is the massive surcharge penalty staring down anyone who missed previous deadlines to get on the ATL. It's intimidating, right? But here is the amazing news. Throughout this explainer, we're going to show you exactly how to bypass that penalty. That's right, we're going to teach you how to avoid paying a single rupee of that $25,000.
To solve the issue, we first need to understand the landscape. Let's briefly look at Section 1, the RS 25,000 problem, and why being a non-filer is simply no longer an option.
The financial anxiety ordinary citizens face today is entirely justified because non-filers are punished heavily at literally every turn. We're talking double or even triple withholding taxes. You face massive roadblocks when trying to buy property, huge hurdles if you want to buy a vehicle, and even steep penalties just for using your standard bank account. Filing your taxes isn't some administrative hobby anymore. It's become a strict economic necessity for survival.
So, knowing that we have to become filers, how do we avoid the fines? That brings us to Section 2, Decoding the New FBR Rule. This is where we translate the legal jargon into everyday language.
The whole secret is wrapped up in a brand new government notification called SRO 1638. Basically, this amends an older rule, SRO 1448, regarding Section 182A of the tax law. I know, that sounds super technical, but honestly, it just means the FBR has completely changed the method for how a new person gets onto the ATL without having to pay that dreaded late fee.
And this brilliantly illustrates the core shift in their approach. Under the old system, you could just file for a single year, pay a standard surcharge, and boom, you were active. But now, the FBR's new system says you must file for 2 complete years. It's a bit more work, sure, but in exchange, you bypass the penalty completely and pay 0 surcharge.
So how do we practically pull this off to protect our wallets? Let's check out Section 3, the 2-year filing formula, so you know exactly which years to target.
The absolute key here is one tiny word, and. Look closely at how it connects tax year 2025 and tax year 2026. It's not an or. The FBR wants to see continuous, uninterrupted records. If you file returns for both of these years within the official due dates, the system automatically makes you an active filer with absolutely 0 surcharge.
Let's bring this down to earth with a real-life scenario. Say you're a shopkeeper running a business in Faisalabad, or maybe a salaried employee in Lahore, and you decide to become a filer in July 2026. This rule applies directly to you. You can't just file your 2026 return and call it a day. You have to go back and ensure your 2025 records are fully filed too.
Now, knowing the 2-year rule is great, but let's jump to Section 4, Common Filing Mistakes to Avoid. If we don't navigate these traps properly, this whole 0 penalty loophole gets completely ruined. So, the crucial point is, do not, I repeat, do not wait for the absolute final deadline of September 30th. In those final days, the FBR's online IRIS portal experiences massive traffic and frequently crashes. If it crashes and your return is delayed by even a single day, you instantly lose the chance to save those 25,000 rupees. Plus, rushing at the last minute often leads to filing the wrong wealth statement, which triggers incredibly stressful audit notices.
Oh, and here's a massive myth we need to bust right now. People think if their income is below the taxable 6 lakh rupees, like students or housewives, they don't need to bother with this 2-year rule. Totally false. To activate your NTN, you absolutely must submit 0 liability statements for both years. If you don't, you stay inactive.
For the retailers and business professionals watching, missing this rule has devastating consequences. If you aren't on that active list, your business partners are legally forced to deduct double the normal tax on your invoices. It absolutely destroys your profit margins. Not to mention, it leaves you with a highly suspicious FBR profile, raising serious red flags.
All right, we've covered the rules and the traps. Let's wrap this up with Section 5, Protecting Your Financial Future, which is your final action plan.
Let's move to and see how this builds your tactical defense.
Step 1. Start gathering your financial footprint today. Bank statements, utility bills, salary slips. Step 2. Make sure you collect property details for both tax years. And Step 3. Consult a tax expert early. A minor data entry error on the portal can cost you so much time and money, so definitely get a professional to look it over.
Now, I have to leave you with a very serious warning derived straight from our source material. The FBR is heavily using artificial intelligence and data tracking. Literally, your every transaction and asset is being watched. Do not try to bypass the system with shortcuts or fake affidavits. The only true way to protect your money is through honest, timely compliance.
Which brings us to our final provocative question for this explainer. Is your financial profile actually ready for the FBR's AI? Becoming a compliant filer isn't just about dodging a fine. It's about securing your peace of mind. So take responsible action today, follow the 2-year rule, and keep your hard-earned money right where it belongs, in your pocket. Thank you so much for joining us.